Okay, we're going to go ahead and get started. Tonight is class number 2 on tax planning before and during retirement, and it's about when do you want to partner with the IRS. I know many of you don't want to, but at some point you're going to partner and pay the tax. Are you going to pay it now or are you going to pay it later? Before we get to that, we're going to recap a little bit from session 1. So session 1 talked about taxes follow a formula. The simplified formula was take all your gross income minus the deduction, which is generally going to be the standard deduction for most, to arrive at your taxable income. Then remember, your taxable income gets separated into ordinary income and capital gain income, and then those rates apply to get what your taxes are owed. And then our income stacks. So ordinary income comes first, capital gains get stacked on top of that. Character matters, so those preferential rates versus ordinary rates, and then our different tax buckets. So that's going to be a little bit what we're talking about tonight as well. And then I want a little bit of a clarification with the One Big Beautiful Bill Act standard deduction, the additional senior deduction. We talked about $6,000 per person. So for married filing jointly, $12,000. And we talked about a reduction of 6% rate if you go over the $75,000 threshold for single or the $150,000 threshold for married. It's 6% per person. So married would be 12% reduction. And then we had a question on how to think through an unexpected expense. We briefly went through an example. I want to give a little bit more of a framework because we're always going to go through something like this. So I think a framework is a good idea. And we're going to borrow something from the military called the OODA loop. So observe, orient, decide, and act. And you can use this for various financial decisions, not just necessarily an unexpected expense. But you're going to observe what happened, what are the facts, when do you need to pay it? Is it a month? Is it a year? And is this a recurring thing? Is this an urgent thing? Is this a one-time thing? And encourage you to write these down instead of just thinking about it in your head, because when we write things down, things become a little bit more clear. And then what options do you have? So we kind of talked about this when I answered the question last week about your different buckets. What do you have available of the taxable, tax-deferred, tax-free, what's in your brokerage, what's in your bank account? What are those different tax impacts? And we'll go through an example here too. And then which one has the lowest overall cost, the least long-term damage? Not necessarily you're going to pick that one. You're going to weigh the financial and the non-financial, but you want to be acutely aware of which one has the least long-term damage. And then once you make the decision, you execute and you adjust. You don't dwell on it. You can learn from it, but you move on. So here's an example of a $20,000 that's needed, and we need it in 1 month. Okay. You're going to write down all your income that you've taken and that you plan to take. So even if this happens like this month, for example, maybe you can adjust your plan depending on what your plan was, but you want to write down everything that you plan to take. That's what tax planning is. So before you moved into the year, write down where you expect to take all your income for that year. So here's just an example of somebody who would be retired, taking Social Security, and they're going to just start with Social Security. They're going to start with what is going to be essentially fixed, what's going to be forced, right? So the Social Security, the bank interest, the brokerage, dividends and interest, all that's ordinary income. And let's just say this person wasn't doing, they're not at required minimum distribution age, so maybe they could adjust their IRA, or maybe they just keep it as is. And then that bottom line is the qualified dividend income. Qualified dividends versus non-qualified, the qualified dividends are capital gains rates. And because they're in the 12% bracket is why it's $0. So then you're going to write down what options you have available to you. Maybe you have all these buckets, maybe you don't. Okay? If you take from cash, there's no tax impact. Yeah, you're going to reduce your safety buffer a little bit. So what was your buffer before? Are you comfortable with that buffer afterwards? And then your taxable account. If you're selling from a stock, do you have some possible capital gains? What would those gains be if you took from the taxable account? And then if you continue in your IRA withdrawal, what's that going to do? Is that going to push you over the next bracket? In this case, would that be over the 12%? If you take from your Roth, your HSA, that's going to disrupt some tax-free growth a little bit. And then maybe you consider a loan. Some people are debt averse, so even if you get a low interest loan, they don't want it. But for some, it's worth exploring because maybe my investments can earn more than the loan. So in this case, they're going to decide to take $20,000 from taxable. Okay, and they're going to take note of any capital gains. So we're going to come back to that sheet of where we listed all our income and what we expected to withdraw, and we're going to add this to it. Okay, so they had a stock with a value of $100,000. They note what they put in there, that's their cost basis, what they've already paid tax on. And then their unrealized gain is what they would pay tax on if they sold all of it. We're only selling $20,000, so our gain percentage is 35%. So you're going to take that $20,000, and to figure out what your capital gain would be, you're going to multiply that by 0.35 to get that $7,000 taxable gain. And then you're going to add that to your sheet. Does that $7,000 push me over the 12% bracket? If it did, I would be in the 15% capital gains bracket. In this case, it didn't, so I'm in the 0% capital gains bracket. If I took another $20,000 from the IRA, you have to think through those tax consequences. Well, hopefully this framework helps a little bit, and it's really about writing it down. Where's all your income sources expected coming from, and which brackets does that put you in? And if somebody was on the Affordable Care Act plan, you have to take those factors into account too. If something unexpected came up and I'm adding additional income, how's that going to affect my premium tax credit? What's the least long-term impact? So depending on your life stage, there's different factors you have to take into account. Questions on that at all? Okay. So the core question tonight is when to pay the tax. Now, later, or do we do a little bit of both? Essentially, do we do some traditional, some Roth, some taxable, some health savings account? Do we do a mix, or do we go all in on one? And think about this in phases or windows, if you will, of tax planning decisions. So we have our working years of where do we decide to save? This is what we talked about, where a lot of our bucket mix is shaped. When we're making X amount of income, are we going traditional? Are we going Roth? When the income drops or it increases, do we need to adjust based on those circumstances? And then retirement to age 65. So retirement could be any age. The age is irrelevant. Up to 65 is what we're going to say. And here you have to think about health insurance is going to be a big one. The Affordable Care Act. If you're taking money pre-59.5, where are you going to access that money? And that's going to be talked a lot about next week, how we can access money pre-59.5. But that's going to be a lot about your retirement age until you reach 65. And then when you reach 63, you're going to want to pay attention to your income for Medicare premium purposes, IRMAA. If you're on the Affordable Care Act plan and you're getting premium tax credit, you're already going to be low enough that you're not going to have to worry about IRMAA. But if you're on a different health insurance, paying attention to the IRMAA. And then ages 66 to 69, why this range is it's after Medicare, and then it's before our delayed Social Security. So if we're delaying Social Security to age 70, this is a different window. Okay, because we don't have that fixed income of Social Security yet, and we're out of the Affordable Care Act premium tax credit, so we have a little bit more maybe flexibility to withdraw more income, whether that's IRA withdrawals, whether that's Roth conversions. And we'll talk about more of these stages in session 4 as well. What makes the most sense when is your highest lever for each window. And then age 70 is when Social Security is going to start regardless, up until your RMD age, 73 or 75. And then we have RMD years, and then if you're married, you have your widow years, which essentially if you're filing jointly, it's getting cut in half. And how do we plan for that the best we can? How do we think through that? And then let's compare retiree tax versus worker tax, because it's a completely different ballgame when we're working versus when we're retired. Worker, our income that we're making from a job, self-employed, whatever, is creating that floor. That's our marginal rate, whether we're in the 12, the 22, the 24%. That's creating that floor. We have to pay FICA. We're paying those payroll taxes. We have limited control over the timing of our income to a certain degree. We can take deductions through retirement accounts. If we have children, we can get tax credits that way and so forth. But we have less flexibility than when somebody's retired, because all that earned income is driving a lot. Versus when we're retired, our spending is driving that. You know, we might be making maybe somebody's making 200,000+ a year, and they're very frugal and they only need 50,000 to spend. That's a totally different ballgame when they're working getting taxed versus when they're retired getting taxed. And they don't have to pay FICA. You have control over those timing those buckets, and using those tax windows that we're going to dive deeper into session 4 is going to be a big deal, because when does it make sense to pull from each bucket depending on when I'm going to start my fixed income and what I'm projecting my fixed income to be, my required minimum distributions to be, my spending to be. And then charitable advantages start at 70.5. Qualified charitable distributions out of your retirement account. So somebody who's charitably inclined, they can start that before required minimum distributions start. And then we talked about the additional standard deductions quite a bit. There's a few things we cannot predict. Future tax law, okay? There's market returns. So many things that we're trying to project out there of what our required minimum distributions are going to be. A lot of those things are a little bit out of our control. Longevity, if we knew when we were going to die, all this would be easy math, right? But it's not quite that easy. Or when we're working, if we knew what we were going to do with the money, if we knew we had enough and we knew what all this was going to be, the decisions would be a lot easier. Because, oh, I'm going to have enough to live on, I can give it to charity, or I can give it to my kids, or whatever. But those things don't become clear until we age a little bit more. The widow timing, we're not able to predict that. Is that going to be a couple months long, a couple days long, a couple decades long, and then just different health events. So we need to focus on what we do know and what is in our control. So we know that pre-tax accounts, traditional IRA money, traditional 401k money, creates required income. And it also can defer tax now. So it's when do we want to partner? Social Security creates that ordinary income. So it's stacking that income the more when we take Social Security or our pension. We know when RMDs start, and those got pushed back. One spouse will likely file single at some point. Roths are tax-free. And then we just talked about retirement income being a bit more flexible. And now we're going to go through a pattern that you're going to see in recent tax law changes. It's kind of revealing, and all this is helping us to make better decisions. the more information we know about what's out there, and then applying it to our unique situation is going to ultimately allow us to pay less in tax. So over the last decade, we've had lower marginal tax rates, we've had delayed RMDs, which is delaying the income that we're required to take, and we've had expanded planning tools for retirees. So our marginal rates used to be, higher than 10, 12, 22%. Our standard deduction got, it was half of what it is now. So more people are just taking the standard deduction, not itemizing their deductions, and then the expanded plan opportunities for retirees with the One Big Beautiful Bill Act senior deduction. The RMDs went from 70.5 to 73 and 75. So it started with the Tax Cut and Jobs Act in 2017. Then it went to the One Big Beautiful Bill Act, making it basically permanent until the next person wants to change it. We know it's going to change at some point, but it is what it is now. It's not set to expire. Like the Tax Cut and Jobs Act was set to expire. This one's not set to expire. So until somebody goes in there and makes a change, those later RMDs are a big deal, 73 and 75. So because you factor that in with the life expectancy and when you decide to retire. So how many years are you going to be in that RMD stage from when you retire, from when we pass away? Again, we don't know when we're going to pass away, but we can take life expectancy into account a little bit. And then our planning tools. Yes?
What are the two numbers in RMD? Are they different for people or what? 70.
So 70, if you're born 1960 and after, it's 75. Before that, it's 73. Why do we have two different numbers for 73 and 75 for RMD age? So if you're born 1960 and after, your RMD age, required minimum distribution, is 75. If you're born before 1960, it's 73. So those couple extra years can be a little bit more flexibility. And then, so QCDs, qualified charitable distributions, they used to be stuck at $100,000, which is a high number still, but now it's indexed for inflation. I think it's around a little over 110 maybe now or something. Higher RMD divisors. So what this means is in 2022, they changed the life expectancy table, which essentially lowered the required minimum distribution amount, is what it basically comes down to. Yes? Social Security. So the question was no Iowa tax on retirement income. So that is Social Security, that's pensions, that's your traditional retirement account. Any money you take from your traditional IRA is not taxed at the state level. So when I was talking about last week where when you're working, you're deferring that money, you weren't paying Iowa tax, and now when you're retired, you're not paying Iowa tax. Essentially, that's Roth money because you never pay tax on that money. The next slide, the purpose of this is to see the highest marginal tax rate and the lowest marginal tax rate over time. We are in a very low tax environment. I know, before I showed it, I wanted to provide a preview. So you're going to see we're in a very low tax environment the last several decades here. And we're not going to predict what's going to happen in the future. Things are going to change. But what we do know, and from the last slide, the tax planning changes a lot, favors the retirees. Retirees and near retirees vote more than workers. And there's a lot of baby boomers out there. So you can glean whatever you want from that. I'm not saying anything, but is it going to stay the same? Is it going to change? At some point it will change. And then I thought this was interesting. I was looking into this today, actually. And like I said, we're in a low tax rate environment. And just looking at the middle tax brackets, you know, we used to be getting 15% instead of 10 and 12. And instead of 22 it was, you know, 25 or higher. Because when you're retiring, you're taking from your IRA or your required minimum distributions, I think this is kind of good to think about of what bracket was I probably in when I was deferring that money. Now, what bracket am I going to be in when I'm taking it out? It can maybe take away some of the sting because it's like at some point I have to be the partner, right? And I was getting matching money, free money. Because again, we are in a low tax rate environment. Whether you decide to prepay tax now for whatever might come, or you're like, well, I saved quite a bit before, and now I'm taking out at a low rate. This one here is basically helping us visualize understanding that we're stepping up in our progressive tax system. This is married filing jointly, but you can cut it in half for single. But just an understanding that we start at the standard deduction, it's like going up the stairs. And then the next level is the 10%. The next level is the 12%. And so forth as we go. In the 22 and the 24, you're going to see those are pretty big brackets. Versus, you know, pretty small at the 0 and 10%. The 32%? 108.9. So those numbers are how much is in each bracket. The next slide here is going to show you when you go to the next one. So these are just showing how big each bracket is. And it's also showing this visually the steps that we go into the next step. This next one is going to be broken down into single, married, and then if you're above 65 or not. And it's going to take away the standard deduction. So you're going to see when that bracket starts. So when the 10% starts, when the 12% starts. It's a lot of numbers, is why I wanted to kind of preview that. But just focus, you know, let's just take the 12% bracket across. So we're not starting the 12% bracket for the third column married under 65 at 57,000. That's when it starts. And then it ends a little bit at 133,000. So this isn't something to memorize, but it's just trying to show a visual of how the brackets, how you're stepping up into the brackets. And looking at, we have 47,500. All that first line is everything that's sheltered by the standard deduction for somebody over 65. You're not paying anything under the first 47,500. And why we're going over this in the pattern of tax planning laws is I think it helps make better decisions when we're working, when we're retired, of when do I pay the tax.
When you fall into the 22% tax bracket, you don't pay 22% tax on all of it. You only pay 22% on your tax. On your income above $132,000.
Correct, and that goes back to this. Right. Good point. So the point made was when we get in the 22% bracket, for an example, and you can take any bracket, but from 133,000 for somebody married to 243,000, that 110 roughly is when you're paying 22%. The first 133,000, you didn't pay 22%. That's why your marginal might be 22%, but like we saw last week, your effective might be 10% or less.
Can you hold that for just a second, because I didn't look at that last column and get that range. Okay.
Yep, you're good. The next one here is the long-term capital gains brackets, because remember, our ordinary income comes and then our capital gain income comes. And recall when we get to the taxable income, when that comes in the formula, we start with our gross, all our income, our gross income, minus the standard deduction to get to our taxable income. That's when we divide the ordinary income, apply those rates that we just saw, and our capital gain income, and apply these rates. So if we have taxable income, which is our ordinary income and our capital gain income after the deduction, that is over 98,000 roughly, we're going to be in the 15% capital gains. A nicer way to look at this, if you're in the 12% bracket, marginal bracket or below, you're essentially in the 0% capital gains bracket. When you go into the 22%, you're going to be in the 15% capital gains bracket. 22 and 24 is 15% and sum of 32. So how I like to think about it is if you're in the 12% bracket or below, you're in the 0% capital gains bracket. That's kind of the sweet spot. As soon as you go over that, then you're in the 15% capital gains.
How many of your people that you take care of are able to stay in that bracket? 0.
It just depends. And not everybody necessarily has a taxable account either, or needs it. Yes?
That is just taking like a taxable brokerage account as opposed to, that doesn't apply to conversions or anything like that.
Correct. So the capital gain income is your capital gains that you would have gained on a stock and a brokerage account, plus your qualified dividends that you would have received even if you didn't sell. But that's automatically getting applied at the capital gains rate. Yeah, no, Roth conversions are ordinary income in the brackets that we just saw previously. So working years, where do we save? Think in those buckets. Think in the taxable, the tax-deferred, the tax-free, the health savings account. Yes?
Somebody pointed this out recently, the HSA is triple tax advantage.
We're going to get there on this next slide here. We're going to answer his question regarding the HSA and the triple tax benefit in this next slide. We're going to take this little by little here. I just want to make sure you understand each account. So the taxable is more of a pay-as-you-go type of account. When you're putting the money in, you've already been taxed on it. It's money you got in your bank account after you already got paid, for example. Then it's going to be taxed in a couple different ways. As it sits in there and you don't sell it, you're going to have interest, like in a money market in your bank account. You're going to have non-qualified dividends. Both of those are ordinary income rates, the 10, the 12, the 22%. Then part of that is going to be qualified dividend income, QDI. If you hold Vanguard Total Stock Market Index for an example, most of that is qualified dividend income. There's a little bit of non-qualified. Automatically, the qualified dividend income gets taxed at the capital gains rate. So that preferential rate. Essentially how that pays out, how the stock, all the funds, all the businesses that it holds. If it has a higher turnover, it's going to kick out more non-qualified than qualified. Like the total stock market is very low turnover versus like a small cap value fund is higher turnover. It's going to kick out less interest. For example, real estate public REITs is going to have a lot more interest in income non-qualified dividends that you're going to be taxed at ordinary income rates versus a tax efficient fund like the Vanguard Total Stock Market. Or international funds can also be a little bit more tax efficient, but not as much as the Vanguard 500 or Total Stock Market. And then we have our unrealized gains. So this only applies when we decide to sell. If we go to that, back to that unexpected expense example, when we sold $20,000 and 35% of that was an unrealized gain, then that's going to be the long-term capital gains rate, the preferential rate.
But we're still in the REITs, you know, some of that small cap or whatever, because we want to.
Yep, and that we're going to talk about asset location after this next slide, because that's important. Yep. Asset allocation is one thing, asset location is another. So then we have our tax deferred. We're deferring the tax, traditional IRA accounts at workplace or outside of the workplace. We're not paying tax when we put it in. We're deferring the tax. Yes? I didn't even turn it on this week. I wonder, is it automatic?
It just, your computer really figured
Where was that? No, not this one. All right, thank you. So traditional, we're deferring the tax, it's growing tax-free, and then we decide to take it out, we're being taxed, unless we're taking it out within the standard deduction. Tax-free bucket, we have Roth and we have health savings account. So Roth, we're being taxed now. We're deciding to pay the tax, no matter what bracket we're in. Then we have tax-free growth, and then we're taking out tax-free. We don't have to worry about taxes again, which is a nice thing. And then we have our health savings account, the triple tax benefit. So these are for qualified expenses, qualified withdrawals. It's going in tax-free, it's growing tax-free, and you take it out tax-free. That's why it's called the triple tax advantage. In addition, there's no FICA tax if you're doing it through your payroll. So that's another 7.65. Next up is asset location. So asset allocation, I think we're all pretty familiar with, is how much in stocks versus bonds and cash. But where we put those assets, if we have 1 fund, 10 funds, where we put those matters. So matching those assets to different tax buckets as we go can be a big deal, because you want to focus on those after-tax outcomes. If I hold all the same funds in my asset allocation, but if person A puts them in the most tax-efficient place and person B doesn't, it's going to be a totally different outcome in a couple decades. So, for example, bonds, money markets. Ideally, when you start accumulating those, if somebody's still working and they don't have much, it's not as big of a deal. But when you start accumulating more and you're getting 10, 20, 30, 40% in bonds and cash, having that in a tax-deferred IRA account, because what that's going to do is going to slow the growth. You're still keeping your same asset allocation, but that's helping your required minimum distribution if you have that concern. And it's not in a taxable account because bonds are kicking off more ordinary income than stocks. Then our tax-efficient stocks. So I mentioned the Vanguard 500 index, the Vanguard Total Stock Market Index, versus REITs. REITs they could go in a tax deferred account. Some people look at that as a partial bond, partial stock. They can go in a tax-free account. But your Roth accounts, you want your expected highest growth stocks or stock. And same thing with your health savings account. So taxable, it's really the total stock market, and second would probably be international. So how we can look at taxable, this is a nice emergency fund when we're working, and also can be a nice cash reserve when we are in our retirement years. It can be a nice layoff fund. It can be a job transition fund. There's a lot of benefits and flexibility no matter the age for a taxable account. So it's what value, what purpose you put on it, and what extra resources you might have. You're at least going to want to build up some type of, whether that's all in a bank or credit union, or you have some of it in a taxable brokerage, you're going to want to build up some type of emergency type kind of fund. It could be a big early retirement fund. We're going to talk about, that's going to be, and then other ways we can access money next week. It's not as tax efficient as we just saw because it's not growing tax-free like in those retirement accounts, as in the Roth, the traditional, the health savings account. But it does provide a lot of benefits at the same time. And if you place the right assets in there, it's not as much of a tax drag as you might imagine. Yes?
So the Roth or health savings, the growth is there some protection for the, you know what, government's money?
Oh, the government could, the question was regarding retirement accounts and growing tax-free. Yes, they all grow tax-free, whether we're talking about traditional, Roth, or health savings accounts. Could the government change that? Absolutely. Who knows what the government's going to do? Could they all of a sudden say we're going to tax Roth? Yeah, they could. Will they? I'm still going to go some Roth, but I mean, yeah, they could, just like they changed the tax brackets, the standard deductions, anybody could come in there and change, you know, Roth IRAs and stuff started, what, early 2000s, I think. So that's relatively new. What's it going to look like in 10, 20, 50 years? Basically, we go back to what we know. We know tax deferred is ordinary income. We know Roth is tax-free. We know health savings account is a triple tax benefit. We're in a very low tax rate environment. Even the capital gains rates are low. There used to not be a 0%. It used to be 10%. Yeah, focus on what is true today. The pros of pre-tax retirement accounts, tax rate arbitrage. So basically this means if I'm in the 22% bracket today and I pull it out at the 0, 10, 12, I ultimately did tax rate arbitrage. I deferred tax at 22 and I'm paying less than that. So I won. I beat the IRS when I decided to pay them. And then your tax savings, when you're putting in your traditional 401k, for example, your workplace, the opportunity to take those tax savings and put it in a Roth IRA or a taxable brokerage account is there. Do a lot of people do that? Probably not, but it's an opportunity, okay? Or maybe it's just more, maybe people look at it as more spending money. And then qualified charitable distributions we talked about. So here's the example. Again, if you're paying 24, but later you're taking out at basically cheaper than what you put in at, you did tax rate arbitrage. Or you can look at Roth conversion wise. And this kind of goes back to why I went over the history of our tax brackets. Because we don't know what the future is going to be. We can kind of glean from what it is now and all the baby boomers and who votes, yada, yada. But essentially when you do a Roth conversion, you're trying to say, save some tax. So from what you put it in or what you're going to pay later on. Yes?
I think there's too much money in Roths now. I'm concerned about the government changing a lot of things in the tax code, but I'm not really too concerned about Roth. Am I wrong? I think it's politically too disastrous to change something that's got that much money in it at this point.
The question was, will Roths go away? I don't know, but I highly doubt it. I mean, it's like retirees and retirees vote. Are they, look at all the recent tax laws that have, who they favored. This is another one that a lot of people don't think about. Contributing versus withdrawing. When we contribute, we are contributing at our marginal rate. So if I'm in the 22%, I'm contributing at 22%, whether I'm doing Roth or whether I'm doing traditional. When I'm withdrawing, I'm moving up the ladder. I'm starting at the standard deduction, and then I'm going to 10, and then I'm going to 12. When I'm contributing, I'm already up there. Because it's my last dollars that it's saving. So when I'm doing traditional 401k, and I'm in the 22% bracket, I'm saving 22 cents on the dollar. When I take that out, depending on what my other income is, I'm moving up the steps, up the ladder. I'm going from standard deduction to 0% to the 10% to the 12%. So the odds that it's all being taxed at the same rate you contributed to, pretty small.
You find it tends to withdraw. Just not.
Let's look at an example. You're always one slide ahead of me. So let's look at an example. Couple age 45. They make 200,000, and you can really put any working age or any income up here. That's not really the point. They're in the 22% bracket. They decide to max out their 401ks, and again, that's kind of irrelevant to the picture we're showing here. They're left with 151,000. In retirement, they're going to spend 150,000. So those are the apples to apples comparison we want to draw from. Both net is the same. Spend and the net income. Note what they deducted at. So they deducted everything at 22%. Do we know this? No. But do we know tax rates were higher before? Yes. Is some of this money matching money? Probably, but you didn't pay tax on it anyway. Why does it matter? Even if they weren't 65, they were under 65. They still made out ahead. So they paid a little bit in the 22%, but most of it was 0, 10, and 12. And let's say you wanted to add on a Social Security or pension. Okay, add it on. They are still going to win out some of it. Or maybe you oversaved or you're undergiving. There's other problems that are worse. Does that help answer that? Some cons of pre-tax retirement accounts. We've heard of the early withdrawal penalty probably quite a bit before 59.5. We're going to go over strategies to overcome that next week. You have taxation of Social Security. So when your income starts stacking, when Social Security starts, when pension starts, and then those required minimum distribution starts, because the taxation of Social Security, those numbers have not been indexed for inflation. So we're being taxed more and more on that as time goes on, and that's why planning can be beneficial. Yes?
So what that means is you do traditional contributions to 401k. You have to take your earnings and count them of your Social Security, which are kind of taxable.
Mm-hmm.
And when you do a Roth contribution, you do not earn
It's tax
income because it's tax-free.
tax-free.
So, again, if you take $70,000 out, you get $20,000, $30,000 in Social Security. One of them, you have $100,000 in tax income.
Repeat that last part.
Here you get $30,000 in Social Security. Under a traditional investment.
Yep.
Traditional 401k, you take $70,000 out of that. Total taxable income is $70,000. I have a lot of other. Just simple math.
Yep.
You're gonna do those calculations on the same. Do that same scenario, $1,000 out in Social Security, $70,000 out in a Roth style. Your tax calculation is only based on $30,000.
Correct. So the question was basically if you're taking out traditional money versus Roth money and you have Social Security, if you're just taking out Roth, your Social Security is not going to be taxed because only Social Security is counting. Versus if you're taking out a lot of traditional, potentially up to 85% of Social Security will be taxable. So you can take that into account a little bit. And then we have IRMA and the premium tax credits. Premium tax credits more so than IRMA, especially before 59.5. And then we have RMDs and the window tax that we'll be talking about a little bit more. We talked about the health savings accounts a little bit. Working years, pay out of pocket as much as you can is the wisest strategy. This is the best retirement account can be one of the best retirement accounts for a lot of people because of the triple tax benefit. So if you pay out of pocket, keep the receipts, at any point in the future, you can pay yourself back for any qualified medical expense tax-free at any age. And then in retirement, so this is a good pre-59.5 vehicle. If you want to retire before then, retirement, you can reimburse your prior expenses either pre-retirement or in retirement. And then you can pay premiums. You can do COBRA. You cannot do the Affordable Care Act premiums. And you can do Medicare B&D. You cannot do Medigap. And then you can do long-term care premiums or qualified medical expenses. And then for those, a little tidbit for those that are like to into health, basically you can do a bunch of different types of equipment or supplements that are out there that can be qualified as well with the letter of medical necessity, LMN it's called. This example here is if we're talking about traditional versus Roth, and we're looking at the same rate of return over the same number of years and the same tax, it doesn't matter what you do. So if I'm going traditional, I start with 10,000. I'm starting with 10,000. It's grown to 20,000. When I take it out at a 25% rate, it's 15,000. If I'm starting with that same 10,000 and I get taxed at the beginning, It's down to 7,500. It's growing to 15. So in both cases, it's doubling. I take it out, no tax, it's 15. So if my tax rate, the rate of return, the time is all the same, it doesn't matter. So it's really about when am I going to pay less tax? Am I going to pay less tax now or later? So choosing where to save as a general starting point, 12% and below brackets, pretty favorable Roth, especially in our low tax rate environment. And these are general rules of thumbs. I'm not going to say do this or that because you can probably find a case where maybe that's not the best decision for that person. 32% and above, traditional is very favored. 22 and 24, a little bit more gray, again, because maybe it's the current rate we're in or what stage of life are you in. But basically, more questions need to be answered to get to the best decision being made. So what are some possible questions to answer? One, what is the money for? As you're going through your working years, as you get older, you're going to have a little bit more clear idea. Do I have enough? What is the money for me? Who are my beneficiaries? Are my beneficiaries kids? Are they organizations? Is it both? What can help drive that traditional Roth question? Because traditional is more favored for organizations, Roth is more favored for people. Is your current tax rate temporary or stable? Are you in your peak earning years? Or do you expect to be earning more income later? Sometimes you know this and sometimes you don't. But answering these questions can help uncover some, like, oh, I never thought of it that way. Yes, I am. No, I'm not. Maybe. Because again, it comes back to trying to make the best decision. Do you have a large pre-tax already? From maybe you've always been a good saver. It's like, wow, I have a lot of pre-tax and not much Roth, or vice versa. Or maybe I got an inheritance and some of that is in a traditional retirement account. Again, this goes back to the tax rate arbitrage. Can you take some of the pre-tax savings and fund the Roth or taxable? Again, not many people do this, so you need to know thyself. Are you disciplined or knowing of that enough? If you saved $500 by contributing traditional 401k, do you take that savings that you would have paid in tax if you would have went the Roth route and put it in a taxable brokerage or a Roth IRA? Are you planning early retirement? Because this can come into play with where's the best way to access money and for how long do I need it? Are you going to be moving to a high tax state or a different state that does tax income? What are your spending needs at retirement versus what the projected portfolio is going to be? A good rule of thumb that, again, it's rule of thumb, take it for what it is. But if you have 70% or more in stocks, if you just want to say I'm going to double my money in real dollars every 10 years, that can kind of give a back of hand napkin math, what the value might be. And that's, again, if you're in enough stocks in their low cost index, all the other caveats. Do you have a pension? When would that pension start? Social Security. So taking all that into account a little bit, and then do you expect an inheritance? And I know money conversations can be tough sometimes, but that can help plan. Yeah, you don't know when you might get it, but is it going to be in what type of account might it be in, and roughly how much might it be? Yep. So got 5 minutes left. Just want to see what is of most importance here. Oh wow, it's not loading. So some mistakes is one of the big ones is try not to be an all in. Like for most people, should we go all in on traditional? Should we go all in on Roth? Should we go all in on taxable? Again, that's going to limit your flexibility of just going up because we're not going to get it perfect. Because we don't know what the market's return are going to be. We don't know what tax laws are going to be. You're trying to make the best educated decision. So going back to that OODA loop and moving on and then reevaluating it as you go. Just like when you do your net worth every year, or you're planning out next year's where my income is going to come from if you're working, where should I contribute based upon the new tax brackets, my income, etc. We talked about that. That was the life expectancy tables. The RMD reality is at age 75, it's just over 4% of what you're required to take from your portfolio. And we know the common number out there is a safe withdrawal rate is 4. I'm not going to go into the nitty-gritty of different numbers that you can take there, but that number has been thrown out quite a bit, even though that guy who started that number came out with a new book with a different number. But that's a safe withdrawal number. So what I'm saying there precisely is these are not high percent withdrawals that you're required to take, especially at these ages. So if you're not spending this amount of money, did I oversave? Did I undergive? What is the money for? Coming back to those questions can help. Go ahead.
So, am I hearing correctly that at age 75, your required minimum distribution will probably be 4%?
It's a little over 4. I just rounded down.
Of your total?
Of your total pre-tax.
Yes.
These are total pre-tax dollars. You're not required to take anything out of Roth. You're not required to take anything out of taxable. You're not required to take anything out of a health savings account. These are traditional pre-tax amounts. So even these are conservative if this was your whole portfolio. So in most people, it's not their whole portfolio. And what the life expectancy tables have is it's your life expectancy plus 10 years. Because when if your beneficiary is a person, they have 10 years to deplete it. So it's even conservative on that standpoint. So if your life expectancy on the IRS tables is 88, the money's never going to run out on the required minimum distribution percentage. So these are based upon, I think I might have so these are based upon the IRS life expectancy tables. So you're going to take the value of your pre-tax account, you're going to divide it by what's called a divisor. If you look up the Uniform Life Expectancy Table at your age, just Google that, and you'll come up with your divisor. At 75, it's 24.6. So 4% of that is just over 60,000. And basically just keeps, you have to take more out as you age. So if this person was 73, they would have to take mid to high 50s out. Because they're younger, they're forced to take less out. Yes?
You have multiple traditional, does your,
You have to take all of them into account.
say you have 3, third comes out of one, third comes out of one part, is it total?
So the question was, if you have multiple retirement accounts, how do you do it? you have to, if the whole balance was, of the 3 retirement accounts was 1.5, you take the same amount. If you want to take it all from one, or you want to split up between the 3, you can do it anyway, but this is the required amount. If you take less, it's a 25% penalty. It used to be 50, so another tax law change for the what you didn't take. So if I took 50,000 and so I didn't take the last 10,000, it's going to be a 25% penalty on that last 10,000 I didn't take. So I know who we so the question was, does somebody send me what my requirement distribution is? I know who we custody with our clients. You get a notification. I know Vanguard, depending on whether you sign up for e-statements, I know you can go in and log in and see it. I don't know if they send it out or not, but I know you can log in and see it. And you can see what you've taken if you've already taken some. Yes.
How do they know what your portfolio
It's out there.
is? Yeah.
Oh,
They know what happened in
I'm sure.
So if you're required to take out the 60,000, then you gotta pay tax.
So the question was, you're required to take 60,000, do you have to pay tax on that? Yes, if it's coming to you. You can use qualified charitable distribution if it's going to somebody else, or basically the top 2 ways that you have. If you want it to go, if you're giving and you're over 70.5, give from your IRA account. Otherwise, if you need the money, if you have to take the money, you can have it go to your bank account and spend it. You can have it go to your brokerage account and reinvest it. You don't have to spend it in, yes.
So all financial institutions are required to send from 5498, they said that the government share that's
Thank you, accountant. We are out of, it's already past 6:30. Any more questions? Yes.
I think you kind of mentioned at the beginning, I apologize. I guess 2 questions. Find the link for next week for the registry, is that, I think,
So we'll put the link for next week back on FinHeads. That's the best way that we have right now to find it, because if you Google the Ignite Financial channel, we don't have enough videos out there for it to come up, and there's other Ignite Financials out there, is essentially why.
and then do you need these slideshows available as well?
So we had a question on that earlier as well about the slideshows. We're gonna work on getting something, whether that's in a PDF or printed, available, hopefully next week. Next week, the doors don't open until 5:30. Class will still start as soon as we can get set up, but there's somebody in here right before that. And next week will be on Roth conversions and pre-59.5 withdrawals.